are macro fundamentals, which can be distilled into three broad buckets: economic fundamentals, measures of financial conditions, measures of risk appetite. Are doing a very good job of explaining most things at the moment across bonds, currencies, and equities. And the primary trend, the kind of momentum of our models remains unchecked. So even though there's some kind of anecdotal stuff around in the last couple of days that maybe we're reaching a bit of a capitulation phase, if we look at our model value for treasury yields, still pointing higher. If we look at our model for, say, dollar yen, even though there's intervention risk around, still points to higher. If we look at our model for NASDAQ, it's had an amazing fall. It's fallen 20% in the last month, courtesy of actually what you guys were just talking about, a mixture of rate vol, which we use as a measure of QT, QE expectations, and the move in credit spreads that you guys just alluded to. So the basic message is that the tightening of financial conditions that has been engineered since that last Fed meeting is just having a rolling effect. And for the time being, at least from a pure macro modeling perspective, we don't see any change, I'm afraid.
So my takeaway from all that is you see yields going higher from here? I mean, how much higher?
Well, so what we do is because we're modeling all these things in real time, we're kind of capturing macro momentum. So there's two key outputs that we produce. One is where do macro conditions say things should be right now, whether it's SPOOs, 10-year yields, dollar yen, whatever. And then secondly, we then compare that to where things are trading. So you can kind of see if there's a valuation gap, because obviously some asset classes lead, sometimes they lag. There's these gaps that create short-term tactical trading opportunities. So right now, we have 10-year yields. The model value is pointing higher, has been for several months, but is accelerating. But the good news, or the compensation news, is that the market is simply keeping track with the move in macro warranted fair value. So there is no valuation gap of note. They're kind of sitting on top of each other. 10-year yields are where they should be given the prevailing macro environment.
Huw, when I look at this, when I look at the government, when I look at the strikes, even when I look at basically consensus for a soft landing, I feel like this economy is going to crater. Don't you want to hold treasuries, even longer duration treasuries, if that's the case, if we go into a deep recession?
Yeah, I get that argument, but I guess that's why the bulls have been loaded up on duration since the start of the year. Now, I know there's different surveys telling you different things, but the Commitment of Traders report will tell you that asset managers have been long for that kind of recession call for the last 9 months plus. The same report says hedge funds are short, but we know a big part of that is polluted by basis trades. Now, I know there are other surveys that will point the other way, so you can pick and choose your data on that. I guess the better answer to your question is it's not obvious at this juncture that actually treasuries are trading as a growth dynamic. It's not obvious that they're going to give you that recession hedge, that actually what they're trading off is the sense that rates are going to be higher for longer, that we're kind of removing the 2009 period on and the new normals reverting to the old pre-GFC normal, that treasuries are focused on budget deficits. They're focused on shenanigans in Washington in terms of the ability of politicians to stay on top of this stuff. And they're focused on the fact that deficits with the supply needs that implies is buffering up against QT rather than QE from the Fed, foreign central banks stepping back from buying, and just the normal sponsors of bond yields at these points, they can afford to step back and wait for better entry levels. So at some point, what you say, I think, will be spot on. I'm just not sure that this is that point.